Stock returns are static. Options are strategic. We've said that a couple times before in our life.
Yes, we have. Yes.
Stock returns are static. You know what that means? That means there's not a hell of a lot that you can do.
Yeah, it's a directional play.
Yeah, it's a directional play. That's it.
Think strategic about it.
We've been talking about, it's not just stock returns are static. We've been talking for a long time about lots of different types of returns. When you trade futures are static. When you trade spot forex, like Pete was talking about this morning, those are static.
Mm-hmm.
So stocks are static, but so are futures, and so are, you know what's static? Digital assets.
Yeah.
So you trade crypto and you trade anything like that, those are static as well. So most investments, you know what's static? Real estate. You know what's static? Collectibles. Because there's very little strategy other than you think you're buying low, or if you think you're buying high, then you think you're going to be able to sell it higher. But there's very little strategy, right?
Yeah.
We're just talking about buying something because you think it's cheap relative to where you think it's going to be. Strategic means there's a lot of things you can do. And essentially, maybe even if you're wrong, you can still make money. When looking at nearly any stock or any one of the other products or asset class I talked about, when looking at any stock's return distribution, they're all similar, nearly normal with some skew, similar probability in either direction, which is not really fair because of positive drift. It's a little bit, everything should be skewed to the upside. So a little asymmetric. But because these distributions are inherent to the underlying, they're interchangeable or unchangeable to the investor. So thus eliminating the possibility for strategic investing. The only risk you look at is historical volatility or how to spread out the distributions based on a standard deviation. This is pretty much the same for every investment, which is what the guys are saying here.
Mm-hmm.
And this is typical for any kind of static investment. When trading options, the distribution of potential outcomes is set by you. Since you pick the options in your portfolio, then you choose the skew, you choose the tail risk, you choose the width and the mean of the distribution based on the implied volatility underlying, the delta of the options, the strategy of the legs, the days to expiration, and whether it's correlated or uncorrelated underlyings. So it is a very different type of investment. There was a question that came up earlier today about why shouldn't you just be passive? And the answer is kind of here. How about all these things we just talked about that at least opportunistically and learning wise, it could be pretty valuable with everything else you do in your life. Some tips on adjusting or managing outlier or tail risk. If you, and this is just for, things where let's talk about this. When you adjust your portfolio of short strangles, puts, calls, whatever it is, you can choose to have wings, no wings. You can reduce some of the tail risk. You can reduce mostly all the tail risk. It's just up to you, okay? But when you have a stock portfolio that's static, you don't have any of those choices. There's no way to have a reduction in risk. There's no way to reduce some of the tail risk. You can't sell there's no derivative strategy that you can use against a piece of real estate, against a long stock portfolio unless you use options, of course, against futures unless you use options, against Bitcoin unless you use options. So the point being here is there's no real way to reduce risk. You can't say a stop order is risk reduction. You can't say that reducing size is necessarily risk reduction, right? I don't think so. I don't think any of those things.
It's the only thing you can do, but I don't think it is the definition of reducing risk.
Let's.
You okay over there?
Yeah.
So good.
No, somebody just sent me a headline. I don't know if you saw this, but Trump just said that he's going to look into deporting Elon.
Saw that too. Yeah, he's going to get Doge after him. I saw.
I
take everything with a smile.
I know. I am. I'm smiling. I'm laughing. Mm-hmm. It's too good. How about adjusting daily portfolio? So if you have an option position on, you can look at things like you can change the duration. You can manage the trade early. You can do something against your trade, like hedge it arb it, whatever you want to do. When you're buying stock, what are you doing? You're just picking a price and you're hoping you're right. When you buy any asset,
Sure.
and you're betting on what? You're betting on
Positive drift.
positive drift. It's okay. What about adjusting for asymmetric risk? So, for example, when you have a portfolio, you can increase the delta of the short strikes. You can go, if volatility is high, you can collect larger credits. If volatility is low, like it is now, you can reduce your risk. Okay? You can set your probability to whatever you want it to be. See, most people don't know this about investing, but you can say something like, you know what? I want to be right 80% of the time. Sure, no problem. Doesn't mean you make money. It just means you're right 80% of the time.
Sure.
But you can set it whatever you want. If you're trading a stock or any other asset that's static, you don't have that option. It is what it is. So in other words, is it a 50-50 shot? Probably. Over time, maybe it's much better than that. But you don't get to choose. You don't get to set your probability of success. If you're selling an out of the money put on a stock you like, you can set it up so you have an 80% chance of winning. It's just a math equation.
That's right. Yep.
And this is the last one here. What about when you want to adjust your expected return? So you can, for example, when you're trading options, you can move your deltas closer to at the money options, closer to at the money, so you can take more risk. You can move it way further away and statistically take less risk, okay? Or just have a greater probability. You can choose a delta that's a fraction of the share price. So you can say, you know what, I like this underlying, but I'm only willing to commit 25%, like choose a delta of 25. Or I'm willing to commit to a 50 delta option, or delta, the equivalent of 50 shares of stock, or the equivalent of 5 or 10 shares of stock. And it's a capital efficient way of doing it. Whereas in the stock itself, it's always just about positive drift. All your dependencies are on positive drift. I'm not saying that it's necessarily bad. It's just a different approach to investing. It gives you a lot less optionality. So options have many dimensions, or they have a lot of options, have a lot of optionality. And they're always adjustable for active traders. And you know what? That's something we probably couldn't have said 25 years ago, or because the technology just wasn't there to do it. Now, you can do whatever you want on your platform. You can literally do any strategy with any underlying in virtually any product. So it's almost inexcusable not to use it. That's why they're so popular. By adjusting the options in portfolio, you're able to construct a distribution that your portfolio will follow that has unique skew, spread, tails, mean, and probabilities. A distribution of stock returns is already set in stone by whatever underlying you trade. The only adjustable attribute is the general spread, which is the volatility of returns. It's just a different way of looking at things. It's not saying that stock returns are bad by any stretch, because this year stock returns have been great. It's just saying that the options are different in that they're strategic, and it gives you more choices, more flexibility.